For the small multifamily investor, it is one of the best asset classes that you can grow your portfolio. As an investor, you need to allocate your own risk to each deal. Now, for me, I will buy anywhere. The reason I adjust my return per area is because a good deal could be a good deal. And yes, maybe some neighborhoods have longer lease times, more turnover, but if I'm getting a higher return, it still gets me to where I'm trying to accomplish. The equity you have is the gunpowder that you can utilize to go buy more property. What's going on, BiggerPockets? It's James Dainard, and we are back on BiggerPockets YouTube channel, and today we're talking about how to underwrite your next small multifamily property. But first, meet my friend Dave. Dave literally wrote the book on real estate note investing for BiggerPockets, and his company, PPR Capital, wants you to be a part of the real estate investment fund. No tenants, maintenance, or property managers, just headache-free cash flow. Dave and his team at PPR invest in mortgage notes and commercial real estate nationwide. Since 2007, Dave's team has never missed a passive monthly income payment. So if you're looking for cash flow, accredited investors can get started at investwithppr.com. That's investwithppr.com. Now let's get back to underwriting our small multifamily deal. A small multifamily rental property means 2 to 4 units. The reason it's classified as small multifamily comes down to the financing. Typically, with a 2 to 4 unit property, investors are purchasing those properties with a residential loan. That's the kind of main benefit of buying small multifamily. When you start going above 4 units, you get classed as commercial financing. So let's break that down real quick. A residential loan gives borrowers access to different types of debt. Typically, it's a 30-year loan, principal plus interest, and you can finance it just like you can your residential house. Average down payments are 20 to 25%. A bank is most interested in the borrower. What is their credit score? How much cash reserves do they have? What is their debt to income ratio? Can they cover the rental property, or is the rental property adding to their income basis? And they're going to be very, very focused on who the borrower is. Once you go to 5 units and above, they start looking at the property more because it's commercial financing. A bank's going to be more focused on what is the income to the property. Will the income cover at that point? And so that is the really big difference. Residential, they're more focused on the borrower. Commercial, they are still focused on the borrower, but they're more concerned about the asset. The asset needs to have a certain amount of debt coverage so the bank will actually lend you the money. So that is the big difference. So the difference between a small and larger multifamily really comes down to the debt. Now you hear this all the time on the internet. Go buy more units, go buy larger units, and that is a great play. We own lots of buildings that are 50, 60 units, and they do well. But what I can say for the small multifamily investor, it is one of the best asset classes that you can grow your portfolio. I've been investing in real estate for nearly 20 years, and I still buy small multifamily 2 to 4 units. It has done amazing things for my portfolio, growing the equity, creating the equity, allowing me to exchange it later for more units. And small multifamily class is a huge part of everybody's growth in their portfolio. So don't ever get worried about larger multifamily or smaller multifamily. They both have a purpose. But the key to small multifamily is being able to underwrite the property correctly. If you don't know how to underwrite it correctly, you won't be able to forecast your cash flow growth correctly over a long period of time. You're not going to be able to forecast your equity gains over a long period of time. And that's what creates the gunpowder for us to grow as investors. So there's 3 main things I look at when underwriting a small multifamily rental property. The first is asset class and location, right? We hear that all the time. Location, location, location. Buy in the right location for the right kind of growth. And that is true and very important when you're buying any type of rental property. You want to look at areas that you think have a high growth that give you the most impact in your portfolio. The location of your small multifamily rental property can have a lot of impact on your pro forma and how you're going to collect income. If it has negative impacts, right? Busy roads, next to commercial, maybe not desired commercial. Does it have bad neighbors? Is there a lot of crime in the area? These are things that can affect your rent growth. And not only that, it can lead to longer lease times. And as a landlord, we are trying to turn our properties as quick as possible. The longer that property sits vacant, the less our return is going to be. The lower your vacancy rate, the higher your return. So those are definitely things you want to look at when you're buying your next multifamily deal. In addition to, look at the historical trends. As I'm looking at buying any type of multifamily multifamily property, I want to know what the average rent growth is for the year. Annually, is it a 2% increase, a 3% increase, or maybe it's 5%? As I'm looking at buying that property, if I look at the historical rates, what's the average appreciation that it gets, what's the average rent growth, that's going to tell me what my performance is not going to look like just today, but over a 1 year, a 5 year, and a 10-year period. So look at those historical ratings. I always want to be in an area that has higher growth. The higher the growth, the bigger the equity spread I'm going to get, the higher the cash flow, which is going to give me more gunpowder to go buy more property or get to financial freedom faster. Each investor is different in the locations that they're buying. I know many real estate investors that will only buy Class A properties. They'll only buy Class B properties and they won't buy Class C. As an investor, you need to allocate your own risk to each deal. Now for me, I will buy anywhere. But what I do is I adjust my return for the asset class that I'm looking at. If I'm buying an A-class property in an A-class neighborhood, I might take a less of a return. If I'm buying in a C-class neighborhood or a C-class building, I might want a much higher return. The reason I adjust my return per area is because a good deal could be a good deal. And yes, maybe some neighborhoods have longer lease times, more turnover, but if I'm getting a higher return, it still gets me to where I'm trying to accomplish. So as investors, dictate your buy box. What class do you want to be in? And if you'll be in any, allocate a return for each area and you'll be able to grow quickly. The next important step when calculating a small multifamily rental property is calculating income. What is this property going to pay you annually and how do you figure it out? The first step in calculating your income is what are your tenants currently paying? Oftentimes when we're buying a rental property or we're looking at a rental property, there's already tenants in the property. The reason this is important is because these tenants are typically on month-to-month leases or they could be on extended leases, 6 months, 12 months, even 24 months. That is a contract that is legally binding, and that's going to tell you what the income is going to be over that duration of time. In addition to in those leases, it's going to break down the actual true net income. It's going to tell you what their expenses are, what they're obligated to pay, and it's really going to show you the financial performance of the property. So anytime that you're looking at buying any type of rental property, whether it's a single family or a small multifamily, you need to evaluate the leases. The leases are going to tell you what the income are today. Oftentimes, you can increase the rent when you're purchasing a property. That's going to increase your return. The more money that you can collect per door or per unit, the higher your income is going to be. So it's really important to always pull comparables to see if A, your tenants are paying over market value and your rents could actually come down in a year, because sometimes that does happen. Landlords can be really good at artificially bumping their rents by giving concessions, free rent, and the higher the income, more money people will pay. So the first reason I pull comparables is to make sure that the current income isn't above market and I'm buying a safe investment. The second reason I pull comparables is I want to see if there's upside in the property. Where's my return going to be in 12 months? If I'm buying a rental property that has a 6-month lease and those rents are 20% below market, I'm going to evaluate the cash flow and the income based on what I'm buying today, but I'm also going to evaluate it in 12 months. If rents go up, what is my financial performance? Am I happy with that income? I might not be happy with it to the day I'm buying it, but if I can increase the rents with comparable data, am I happy with the return after I'm finished? But the things to avoid when you're pulling comparables. If you're looking at a small multifamily, let's say it's a duplex, and it's a side-by-side. There's no one above, there's no one below. They're nice, clean units with one shared wall. That's going to get you a much higher rent comp. If you're looking at a duplex that's top and bottom, that might get you a lower rent comp because people will pay less typically for people walking on top of each other. So those are things to consider when pulling your rent values. After I pulled my rent comparables of similar product, I need then to calculate the expenses on the property. Just because you're getting paid rent doesn't mean that's what you're walking home with. You have your mortgage cost, which you need to pay to your bank to facilitate the purchase. But then there's the other expenses in the property that are going to dwindle down your income. Typical type of expenses inside of small multifamily are going to be your property taxes. How much is your monthly taxes that needs to come off your rent income? Then there is your insurance, and insurance can vary in all different types of states. So it's really important that you price your insurance for the area that you're purchasing in. When I buy in Washington State, my typical rental insurance isn't that expensive. On average, I'm paying about $100 a door, maybe even a little bit less. Now, if you go into other types of markets, let's say Florida or Texas, their insurance premiums have gone through the roof and they can be a lot higher. So wherever you're looking at buying that property, research those insurance premiums, you need to work it into your pro forma because it's going to substantially affect your cash flow. Taxes, insurance, and utilities are your core costs when calculating your expenses, but then there's other variable expenses that you want to pay attention to and work into your pro forma. As an investor, when I'm looking at purchasing a rental property, I always work in a maintenance expense. Typically, I allocate 1% of my total annual income into a maintenance expense in a reserve account that will pay for any type of repairs over time. Tenants will give you damage deposits that will oftentimes cover the move out, but items like roof, furnaces, general maintenance, and upkeep can wear out over time and dramatically affect your cash flow. So I build in 1% of annual income into my expense and I put that against my pro forma. And lastly, are you going to do property management or not? The first 10 years of me being a landlord, I never used a property manager. I self-managed. The reason I did that is I wanted the highest performance of the property. Typically, property managers charge 5 to 10% of your gross income. In addition to, they can charge lease-up fees depending on the rate that they're charging. That is okay, and it can make you very headache-free for you as a landlord, but you need to factor in for those expenses. So to determine, are you going to use a property manager or are you going to self-manage? Figure out those costs, price out those costs, and work it into your pro forma. So after I've evaluated the location and potential income of the property, lastly, I want to evaluate the value of it. What is the market value today and what am I paying? Now, many investors are chasing cash flow where they don't really care if they're paying market value because they're getting a great return on their money and they're happy with that. They may want a 7% return. They can put 20% down, full market value, and that's what they're getting. Then there's the other half of investors that are trying to utilize leverage when they're buying small multifamily. If you are overpaying for that property, you are starting with negative equity. The more negative equity you have and you overpay, it's going to be harder to then refinance and pull out cash later. It's going to be harder to pull out any type of investment HELOC on that property. Loan to value in your equity position makes a huge impact as you're trying to grow out your portfolio. The equity you have is the gunpowder that you can utilize via a 1031 exchange or accessing more debt to go buy more property. So checking the value of the property is essential when you're buying a multifamily deal. So spend the time, figure out how much capital you have, what are you trying to accomplish, what is it going to take for you to buy that asset, and what is your minimal return. So I want to thank everyone for tuning in for how to underwrite your next small investment property. If you enjoyed it, like and subscribe below. And for more information about how to underwrite and analyze your next deal, check me out on JDaneFlips on Instagram or jamesdainard.com.